Today we are going to talk all different types of things regarding the car market because there are a lot of trends and a lot of news happening over this past week that I think is important to go over because not only does it affect you if you want to buy a car soon, but also it affects the economy. And quickly before we get into it, one thing I want to acknowledge, because people always ask me in the comments, hey Michael, where is everybody? Because you're always walking around, and is Miami empty or what? Well, it's almost 2 o'clock in the afternoon and it's 87 degrees out here plus the humidity. So my guess is people are hiding inside the AC. No one really wants to be out in this. Summer is here if you live in South Florida. Now, one of the biggest expenses that people have besides their rent or their mortgage is their vehicle. And a lot of people have been spending too much money on their vehicles. In fact, about half of American drivers right now say that their car expenses are the reason that they can't save any money. Think about that, guys. 50% of people say they're driving a car and it's so expensive just to drive and maintain this car, they can't save any money. And these people are spending about 20% of their monthly income on auto loans, fuel, insurance, and maintenance. Well, if you follow that rule and you follow your housing rule and you don't spend more than 30% of your income on your housing, that's already 50% of your income gone just from your house and your car. And that's if you're in that range. A lot of people go way above and beyond that now. The financial experts, they say that you're supposed to spend no more than 15% of your monthly income on a vehicle. But about 10% of drivers say they spend 30% of their monthly income on driving, and another 12% said they find themselves living paycheck to paycheck due to the financial strain of their cars. I mean, this is insane. It really is. This just goes to show you like how far out of whack everyone's priorities are when it comes to cars, right? Because I understand that cars are more expensive today than they have ever been, but also there are plenty of dealerships out there that cater to cheap cars, guys. Look at my buddy Brandon on here from Car Questions Answered. His car dealership only sells cars that are $5,000 or less cash. And in 2025, that's pretty incredible. Like even my first car that I bought back in 2003, something like that, that car cost like $7,500 back in the day. It was a pretty nice newer car. It was only a couple years old and it was a Pontiac Grand Am. And it was a pretty great car. I had literally zero issues with it. It was a 4-cylinder, did well on gas. I used that car to deliver pizzas until I crashed it in a pretty bad accident and the car got totaled. But what I'm saying is that that car cost $7,500 back in like 2003. And now you can buy a $5,000 car. Yeah, it's gonna be kind of a piece of crap, but if it runs and it gets you from point A to point B for $5,000 or less right now, jump on it. Don't have it be, a major part of your life in terms of payments. That's ridiculous. And that's how you know people overextend themselves, because you know that opportunities out there exist like that, yet people fail to take advantage of them. Everybody wants to look cool, everybody wants to look rich, and look at me, I'm driving the latest and greatest model, and that makes me important. Now here's something that the experts say that I agree with, which is that you should not be spending more than 15% of your income on your car, but also that you should be aiming for a 20% down payment and no more than a 36 or 48 month loan. Well, in case you're doing the math, that's 3 to 4 years. A lot of people do minimum 5 years. A lot of people are doing even 7 years now for auto loans, trying to stretch out that payment so they can drive a car that they really can't afford. And this is yet another thing that people just kind of have to learn the lesson the hard way on. Like, okay, you want to drive an expensive car, you want to have a $700 a month car payment, and you make $3,000 a month. That's probably not going to work out too well for you in the long run. But sometimes people just need to go through that, see the financial consequences of it, and realize, yeah, that was a bad idea. I'm not going to do that again. Apparently, another thing that was a bad idea is the EV tax credit. As it stands right now, consumers can get up to a $7,500 tax credit on a qualifying EV purchase, and businesses can actually claim the deduction too, which has created a leasing loophole for EV purchases. That's how you can lease an EV car that was not actually made in the United States or doesn't qualify and still actually get a decent sized tax credit. But now they're looking at getting rid of that and replacing this EV tax credit with a possibility to deduct the interest that you would pay on your car loan if you buy an American-made car. Now, one quick thought I had about this as I'm editing this video is like, yeah, you get to deduct the interest on your loan if you buy a US-made car, but that encourages people to take more debt and kind of perpetuate this cycle of people borrowing more than they can really afford to buy a car, rather than encouraging people to buy a car with cash. What happens to people who want to buy a brand new car with cash? What kind of incentive do they get? Are they going to get, 48 months worth of interest as a tax credit? That's not really fair to somebody who's kind of doing the right thing and saving enough money to actually buy a vehicle versus somebody who's drowning in debt. So just another thing to think about, and you kind of look at where these incentives are at, and it kind of incentivizes the wrong behavior. And if this actually happens, it's going to get rid of the consumer tax credit immediately, and it will phase out the commercial tax credit by the end of 2025. So you might still be able to take advantage of that loophole if you lease a vehicle, but it will no longer be available if you were to buy one and try to get that tax credit up front. Now, this was an unfair advantage to begin with for EV cars because, first of all, manufacturers could just raise the price of these vehicles and essentially they would be the ones getting that tax credit because they could sell their vehicles for more because now the government is subsidizing them and people could afford to pay more for those cars. Well, fast forward to today, this new way of doing things isn't going to be much better, guys. Like, I'm happy they're not just subsidizing one type of vehicle. They're looking at all American-made cars, but how much is being able to deduct the interest really worth to the average American on their taxes? Well, probably not that much. The idea behind this is that it's supposed to save the average American a few $100s per year, which might offset the tariffs that could impact the vehicle that you're going to buy. However, most taxpayers use the standard deduction, which means if they don't itemize their deductions, they won't be able to get this deduction anyhow. So a lot of people probably won't end up even using this new tax credit, which means that the auto industry will have a level playing field once again, unless people do start actually taking advantage of this, but I don't think it's going to add up to $7,500, especially in the first year. The prior EV tax credit was way more beneficial and way more of a subsidy than what we're looking at with this new deal potentially coming down the road. But this is going to be yet another blow to the electric car sales because already they haven't been doing so great because they're typically more expensive than a gas-powered car and there's not as high of a demand. Not as many people drive them. Well, now, if they get rid of this EV tax credit, there's going to be even less people driving them. Toyota just came out this past week and they announced that the tariffs as they stand right now are going to cost them about $1.3 billion just in April and May alone. That sounds pretty hefty. And the main reason for this is because of the 25% tax on aluminum, steel, and auto exports, which is currently in effect, even though the 25% tariff on Japan is on pause. Because even though Toyota is a Japanese company, they manufacture their vehicles all over the world. So the CEO of Toyota is saying that most likely we are going to have to raise our prices on our vehicles soon, which might not hit Toyota customers as hard as other brands because Toyotas are known for being affordable vehicles. As it stands right now across all different types of imported vehicles in general, the lowest amount of tariffs on an imported vehicle is about $2,000 right now, and the highest tariffs on some other vehicles are coming in at around $15,000. So it really depends on the manufacturer and the country of origin on how much the tariffs are on any given imported vehicle right now. So you can see that this new tax credit to deduct interest on your loan could actually favor American vehicles if implemented properly. It's not official yet, but it is something that is in the works to try to encourage people to buy American-made cars, which clearly has a major impact on our economy, which is why I think it's important to bring this stuff up. Now, the vehicles that are least likely to be impacted by tariffs because they are mostly American-made are Teslas, Hondas, believe it or not, and Jeeps. Those vehicles all are made highly of domestic parts in domestic factories right here in the US. However, General Motors vehicles is in a much worse position because they only make about 45% of their vehicles within the US, which means they are very vulnerable to the tariffs. Ford is another company that is also vulnerable to the tariffs, and they're looking at raising prices on their Mustang Mach-E, their Maverick pickup truck, and the Bronco Sport by as much as $2,000 on some models. So they already can't sell these cars now, and they're going to be raising the price by $2,000. Let's see how well that works out for them. And I think this is kind of the wake-up call that a lot of vehicle manufacturers need to see as well, right? Like, you have people that can't really even afford the cars that they're buying right now, combined with the fact that they may even have to raise their prices and people already can't afford the cars at today's prices. These auto manufacturers are going to have to start rethinking the type of vehicles they produce and what consumers are demanding, because people need more affordable vehicles. That is the bottom line. What kind and what they're going to have to do to make that happen, I don't know. But they did it all these years in the past, guys. Before I moved to Florida, I worked at a couple different car dealerships. My last job in Illinois was at a car dealership. And back then, you could still buy a brand new car for like less than 20 grand. I know inflation is part of it, but the other part of it is manufacturers used to make more affordable vehicles. Yeah, they were bare bones, they had no amenities, still had crank windows, all that kind of stuff, but who cares? There's a brand new car for 15, 16K, you know? Nowadays, that's basically unheard of. Now you're looking at a brand new car starting at a minimum of like 35, 40 grand. So it's no wonder people are saying that, you know, this is the reason they can't save money, because people are buying cars that are just too expensive and they're not shopping around for a good deal and buying that $5,000 car for cash and driving it till the wheels fall off. Another thing that people have been doing is they've been rushing out to buy vehicles in anticipation of beating the tariffs. And guess what? People have to finance these vehicles. Ally Financial, they received about 3.8 million loan applications in the first quarter of 2025, but it approved way fewer applications than it has in the past. Another company called Credit Acceptance said that they're seeing a resurgence in their business after signs that newer borrowers are starting to struggle to keep up with the payments. So there's always going to be a lender out there who's going to be willing to take advantage of this situation, right? Like, yeah, you need a loan? I can set you up with a loan. It's going to cost you a much higher interest rate, but I'll let you finance that car. And if you don't make the payment, we'll take it back, just like buying a house. Capital One, they say they're actually making more auto loans than they did 1 year ago, but they're being more selective about who they're lending to right now. More than half of the bank's auto loans went to borrowers in the highest tier of credit last quarter. So this falls directly in line with the same thing that's happening in the housing market, guys. The people who are buying brand new cars, people who are buying homes right now are the wealthy. People who are making multiple six figures a year, that have good credit and can afford today's lifestyle and today's prices. That's who's buying this stuff. But that is not reflective or representative of the average American. That's the thing that people need to understand. And you can see by taking a look at this chart right here, going back to 2020, this is Ally's auto loan application volume. And you can see it is steadily increasing. But just because the application volume increases doesn't mean the amount of loans going out the door increases, because they are accepting fewer and fewer applicants because people just don't have the credit or the debt to income ratios to be able to purchase these cars, which is another reason why the car sales are so slow, which mirrors the housing market. When prices are too high, people can't afford it, and they're forced to finance a higher amount. Less and less people qualify, therefore sales come down. And at the same time, you have a lot of people that are keeping their older cars longer than ever, because the average age for a trade-in vehicle are going up, up, and up. And to show you how this system is working out for people right now, about 38% of auto loans were extended to borrowers with credit scores of 760 or higher in the fourth quarter of 2024 versus 33% 3 years earlier. So more and more of the auto loans are going to people that have higher credit scores and higher incomes, which is leaving people at the bottom part of the borrowing sector to look for alternative lending that usually is far more expensive. It's funny too, because here in this story, they say people with lower credit scores or first-time borrowers should consider lining up a co-signer or loan from a credit union before walking into a dealership. Like, anybody who's dumb enough to co-sign for somebody buying a vehicle right now, you deserve to have that payment because one day that person's probably going to miss it, guys. If they can't buy the car on their own, they shouldn't be buying the car. It goes the same thing for buying a house. You know, if you need help from the bank of mom and dad and you need to have, you know, all these other things going on to be able to buy a house, you can't actually afford it. But this is literally the advice that people are giving now to tell people to get out there and buy cars. Because why? That's good for the economy. Anytime you buy a vehicle, who gets paid? The lender gets paid. They make money off the loan that they're giving you. The state or the local counties make money off the vehicle license plate and registration fees. The car dealership makes money. The manufacturers make money. Everybody makes money. So yeah, of course, line up that cosigner. That's a great idea. And like I talked about earlier, the experts recommend not going past 48 months, which is 4 years for a car loan. Well, check this out. Many people right now are opting for 84 months or longer to keep the monthly payments manageable, according to Edmunds. That's a 7-year car loan, guys. 7 years. Most people don't even keep their cars for that long, let alone having to pay it off. I'm guessing that in the future, these loan terms are going to extend past 10 or maybe even 15 years, and people are not even going to ever pay off the car. But there is one thing that's working in favor of the American car buyer right now, and that is that a lot of dealerships are kind of shielding buyers from tariffs because of the oversupply of inventory that they've had on their lots for a while now. The latest CPI report that came out in April shows that new car prices were flat. Not that the CPI is very reliable, but this is all the data we have on this. But the latest report says that brand new vehicles were up 0.3% year over year, and used vehicle prices are down 1.5% from a year ago. But they're saying one of the big reasons that price hikes have been minimized for brand new vehicles is because there have been so many vehicles sitting on the lots already. So these cars are not subject to the tariffs. And they have been selling some of these cars. They have been successful in moving some of them. And I'm not surprised because I've shared with you guys some of the deals that I have seen, you know, giving $18,000, $20,000 off of MSRP for a brand new Jeep right now. That's not a bad deal. And I saw a lot of the comments saying, well, that's because they raised the price, you know, by however much and now they're calling it a deal. Like, yeah, you can sit there and complain about it all you want, guys. But the fact of the matter is, would you rather pay $18,000 less or $18,000 more? I think the choice is pretty simple. So people are always going to have things to complain about, but to me, this isn't one of them. And besides, if you're in the market to get a brand new car, you're looking for a deal, and that's a deal. You'd rather get an $18,000 discount than a price hike, wouldn't you? But according to data from CarPro reports, they are showing that we had around 3 million vehicles sitting on dealer lots in March, and in April that dropped down to 2.6 million. So they were able to unload 400,000 brand new vehicles throughout the month of April nationwide. That's pretty good. We still have a 60-day supply of inventory on the market, so there's still a lot of cars out there going unsold, and I imagine that's going to continue to be the case because, once again, who's buying these brand new vehicles? Who's buying houses? People who have the incomes and the credit scores to be able to do it, guys. That's it. Nobody else. And since it's such a small category of Americans that fit that criteria, don't expect these car sales to explode anytime soon. Other manufacturers like Hyundai, they have guaranteed pricing through the end of May. So even though some of their vehicles are going to be tariffed pretty soon, they're still guaranteeing, hey, this is the price through the end of May, so come and get it now before the price goes up. So they're using those kind of tactics to get these vehicles sold. Ford has even extended their employee vehicle pricing program until the 4th of July this year. So that is a pretty generous extension, and they're going to be essentially absorbing those tariffs in the meantime. But that's what I was saying before. If these companies have to do something like that, give people employee pricing until the 4th of July, and then once that passes and they're not able to really sell cars anymore, what's the next step? It's going back to the drawing board and finally creating vehicles and manufacturing vehicles that people can afford brand new, guys. No more of this 40, 50 grand starting price nonsense, because that is unaffordable for the average person. And just to show you that the CPI is not a super reliable number, according to Kelley Blue Book, they actually saw prices at the dealerships rise about 2.5% month over month in April, which is a lot more than what the CPI showed us. Now, one last thing about the tariffs, there's actually a little bit of good news on this situation, because something that just happened is that the Trump administration is going to cut the tariffs on the low value parcels from China down from 120% down to 54%. This is the de minimis tariff. And under the US tax law, the de minimis exemption allows companies to avoid import taxes and customs inspections on international shipments with a retail value of less than $800. In February of this year, this provision was suspended and they imposed a 120% tariff on all packages coming in from China. But on Monday this week, the US and China have agreed to suspend most of the tariffs on each other's goods while furthering the trade negotiations. So that is actually a glimmer of hope that maybe this situation is going to simmer down. The US agreed to lower the base level of tariffs on most Chinese goods to 30%, down from 145%, and China said it was going to cut its levies on US products to 10%, down from 125%. So that's really good news on both ends. And then the de minimis tariff will go down from 120% down to 54%. So maybe things will fizzle out with the tariff situation and move in the right direction, and we can settle on something that works for everybody. That's what I'm hoping for. So let us all know if you're planning on buying a brand new car. Let us know if you're planning on financing it. Let us know if your car is forcing you to go broke and not be able to save any money. And if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.